Hey everyone, and welcome back to the channel. Today's video is going to be all about Facebook and their full year and fourth quarter 2019 results, which just came out a couple of days ago. So what you can expect from this video is a breakdown of their results for the fourth quarter and the full year. We're then going to revisit the analysis for Facebook to see what's changed and see what potential growth we could expect out of Facebook in the future. And towards the end, we're going to take another look at intrinsic valuation. And as you can see from the title, one of our models suggests that Facebook could be heading towards a $1,000 per share stock price. So that is all what we're going to talk about in today's video. And in the background, I do have my air conditioner on, so you might hear a slight hum. It is very, very hot in Melbourne today. I think it's about 35 degrees or 40 degrees Celsius, that is. So I think that's about 110 Fahrenheit. So it's very, very hot. So bear with that. But if you do enjoy today's video, make sure you leave a like and let me know your thoughts down in the comment section below. But for now, let's jump into it. So to start this video off, let's take a look at the press release that Facebook brought out with their fourth quarter and full year results and have a breakdown of some of the major numbers that Facebook was reporting to us this quarter. In the fourth quarter of 2019, revenue came in at $21 billion, which represented a 25% increase year over year. And for the full year, revenue came in at $71 billion, which represented a 27% increase from the previous year. Earnings per share, however, came in at $2.56 compared to $2.38 in the previous year, which represents just an 8% increase. And for the full year numbers, it came in at $6.43, which actually represented a 15% decrease from the previous year. So Facebook is going through this period where, because of the safety and security concerns that have been raised over the past couple of years, they're spending a lot of money to hire more employees and to spend money in other ways to protect themselves for safety and security. And as a result, not as much money is coming down as profit at the end of the day as it has in the past. Some of the more important numbers for Facebook include daily active users, which came in at 1.6 billion users, which represents a 9% year-over-year increase. Monthly active users came in at 2.5 billion, an 8% increase year-over-year. Their family daily active people, family daily active people, I'm sorry Facebook, but that title sucks. But this is a new metric, and basically what they're talking about here is how many people are using at least one of their products, whether it's Facebook itself, Messenger, WhatsApp, or Instagram. But this number came in at 2.89 billion people, which represented a 9% increase year over year. At the end of the quarter, Facebook also had just under $55 billion in cash on their balance sheet, or cash and cash equivalents, which means that they have plenty of cash that they're ready to deploy either into some share repurchases if their stock becomes a little bit cheaper. They kind of held back on the share repurchases recently just because the stock price exploded so much. But if the stock price was to reverse a little bit further, maybe they can buy some more stock, or they can make further investments into their payment systems and other areas that they're looking to expand their business into. Now, let's jump over to my analysis spreadsheet and see how Facebook's numbers have changed since last year in terms of their debt ratios, their return on invested capital, their growth of the core fundamentals, and then ultimately intrinsic valuation. What is Facebook worth today compared to last year, and is it offering a better deal than it did previously? Alright, so we are over here in my analysis spreadsheet, and for those who aren't aware, you can go ahead and download this spreadsheet and apply it to any business that you're looking to analyze. The link is down in the description below. It's completely free. But what I have here is the spreadsheet that I filled out last year when I was analyzing Facebook, and we are going to go ahead and compare this to what it looks like today. So basically, I've gone ahead and copied over all of these numbers to the new spreadsheet, which is right here. And the new spreadsheet, of course, includes the 2019 column. So let's have a look and make some comparisons. So the first thing I want to have a look at is the growth of the business and how that's changed. So back in 2018, we can see that they had long-term growth of 60 to 80%. And in 2020, now that we have the new year that has come out, that has decreased slightly, although it is still absolutely exceptional. We have it ranging between 48 and 59%. Last year's results were fantastic for Facebook. They had 37% sales growth, 40% earnings per share growth, 13% equity growth, and 6% growth in their cash flow for owners, I should say. And in 2020, a similar story occurred. So sales grew at 27% instead of 37%. So quite a big slowdown, but they are still growing very quickly. Now, earnings per share was actually down in 2019 from 2018. So that is a substantial change from a 40% increase. Equity, however, did grow by 20% compared to 13% last year. And then in terms of cash flow for owners, it grew at 30%, whereas it only grew at 7% last year. So a dramatic improvement in equity and cash flow growth. Earnings per share slowed down due to some factors relating to increased security costs, and then sales still grew at quite a high rate. The next thing that we can look at is their debt ratio. So in 2018, they had a current ratio of 7.2, which is absolutely fantastic. I like to see this above 1 or 1.5 or 2. If it's above 2, it's excellent. If it's a 7, that is just unreal. It means they basically have no short-term liabilities. And we can see that that was the case. They had $50 billion in short-term assets and only $7 billion in short-term liabilities. And we can compare that to this year, where Facebook still has a very high current ratio of 4.4, but it has gotten a little bit worse. So you can see that they have $66 billion in short-term assets, and now they have $15 billion in short-term liabilities. So their short-term liabilities doubled. Now, last year, they also had a debt-to-equity ratio of about 0.16, which is pretty much as good as it can get. It really doesn't get any better than that. I'm looking for this to be below 0.5, or I'm okay with it if it's below 1. Anything above 1, I'm sort of starting to get a little bit worried. And we can see that in 2019, that increased to 0.32. So it did increase, it doubled. However, it is still well below 0.5, so they are excellent. Facebook basically operates with very little liabilities, and they actually have $0 in long-term debt. The next thing that we can look at is the return on invested capital. So in 2018, they had a return on invested capital of 26.53. In 2019, that grew to a 28.5, which is fantastic. So it actually increased. And then we can see that the 10-year average back in 2018 was 20%, and that grew to 22%. So management's effectiveness at investing within the business has gotten better, and we can actually see that by this graph. You can see that their latest year, which is here, was their 28.5%. It's their best year yet, I think. Yes, it was. It was their best year in terms of return on invested capital. Just ignore these numbers down here. These are incorrect. They should be pushed across 1. So this big one here is 2019. But you can see that it is progressively getting better, which means management is getting more effective at investing within the business. Every additional dollar that they invest, they're generating more back than the previous dollar, if that makes sense. And then, as promised, let's take a look at the discounted cash flow to see how the value of Facebook has changed according to my models. So if you've seen some of my previous analysis videos on Facebook, then you would know that I've used growth rates in this example ranging from 10% to 18%. And the starting cash flow here is based on the 2018 cash flow for owners figure that I calculated. If you want to learn how I calculated that, I'll leave a link to a video down in the description below. But you can see that the discounted cash flow last year at the start of the year gave us a buy price range of somewhere between $80 and $80 per share and $132 per share if you were targeting a 22% return. Now, just to give you a reminder, the stock price at the start of the year for Facebook was about $150 per share, so slightly out of this range. Now, if we fast forward to this year, we can see that I've updated the cash flow for owners for the 2019 figure, which was $28.7 billion, according to my estimation. You can see that the buy price has increased slightly, but is still below the current stock price. So it has increased to $105 up to $170 per share as a buy price if you're targeting a 22% return. So you might also be wondering where I got the $1,000 per share. How could Facebook get to $1,000 per share? Well, essentially what this model is suggesting, this bottom model, or all of these models for a fact, is if you buy the stock at this price, then if these models are accurate, you will 8 times your money over the next 10 years. That is what a 22% compounded return is. 8 times your money over the next 10 years. So if Model 5 was to be accurate, if Facebook grew at approximately 18%, grew their cash flows at 18% per year, and you were able to buy it at $170 per share, then you would most likely 8 times your money over the next 10 years, and 170 times 8 is pretty much $1,000 per share. So that is how I've come up with that number. If they can grow at 18% per year from here, then it's likely their stock price will be around $1,000 per share. So it's just a matter of whether you think that Facebook can achieve that and whether it is reasonable to expect that they can achieve 18% per year. For me, I think it's more likely they'll grow at a slower rate. The last thing I like to do when it comes to intrinsic valuation is to see what is the expected return based on the current stock price. So at the time of recording this, the current stock price is about $208 per share. So if we change the required rate of return so that the middle model, Model 3, has a buy price of the current stock price, you can see we've done it here, this number here becomes our expected return. So according to this middle model, Facebook currently has an expected return of 15% per year compounded if you were to buy the stock at the current stock price. Now, remember, that does not include a margin of safety. So if they do not grow at 14% per year, if they underperform, you will not make a 15% return, which is why I like to target something closer to 22%, which means that I have a margin of safety for errors in my valuation. So based on that, if you were looking to make an investment in Facebook, or maybe you already have a position like myself, but you're considering adding some more, these are kind of the questions that you need to ask. Do you think that Facebook can continue to grow at 10 to 18% in the future? And then not only can they grow in that range, which ones do you think are more likely? For me personally, I think it's much more likely that over a 10-year period, they grow somewhere in the 10 to 12 to maybe the 14% range. But certainly, I think 18% is really pushing it at the top. And then the other question you need to ask is, what return are you comfortable with getting? If you want a 15% return with a 50% margin of safety, then you really need to be targeting a 22% return. But if you're comfortable with 15% with no margin of safety, then you can just put 15% in there. Or maybe you want a 7% return with a 50% margin of safety, which again would mean you would put 15% into the required rate of return button. But of course, as always, I would love to hear your thoughts on Facebook stock, this video specifically, and what are your thoughts about Facebook as an investment, all down in the comment section below. I will be responding to questions and comments after this video goes live. But if you did enjoy the video and you want to see more, the best way that you can show me is by leaving a like and hitting subscribe if you haven't already. If you haven't subscribed, what are you doing? What are you doing? You're probably the only person watching this video who hasn't subscribed. Everyone's subscribed to this channel. It's a huge channel. You're missing out. I don't know why I make these stupid outros. And then I've talked for so long that I don't want to do it again. So that's it. That's the outro. Thanks, guys. I'll see you later.